Alright, hey guys, this is Vishal from Uncharted FX. Before we begin with the video, if you enjoy the content and like this video, please give this video a like and also subscribe to my YouTube channel if you haven't. So today I wanted to talk about generally what everyone's talking about, and that is the Federal Reserve rate cuts. So if you follow my work through my blog or through my social media, you know that I believe that central banks around the world, especially in the West, are going to be cutting interest rates. Australia cut interest rates 2 weeks ago, so they went from 1.5% to 1.25%. And talk is that they're going to be at 0.5% by next year. We have the Federal Reserve who is up next week. And there's rumors they might be cutting rates or they're going to take a dovish tone. I'll talk about why I believe that they will have to cut rates, possibly very soon. And again, let's start with the basic mandate of central banks. So they started being the lender of last resort. That was their original mandate. And then as we went through this mercantile, what we call Keynesian economics, they shifted from that mandate to a mandate more about maximizing employment and handling and dealing with inflation. And I argue that today's central banks pretty much have one mandate, and that is to keep assets afloat. We're seeing this happen with the Bank of Japan, the Swiss bank, and the European Central Bank. So let's start with the bond market. Generally, as I said, as bonds go up, it's an inverse relationship. So as bonds go up, the yield declines. So in this case, the 2-year, 10-year, 30-year, those are the ones I watch. But let's quickly talk about the European bonds. So this is a weekly chart. The Euro bonds are now at all-time highs. And this is the funny thing, because the ECB came out 2 weeks ago and said that they are open to cutting rates even more negative, so the deposit rate into more negative territory. Like this is all that they can do. Central banks are running out of tools in their toolboxes, and Europe has an issue because when there is a recession, you're supposed to cut rates. They're already at negative. There's not much more they can do than go even more negative. So same applies with the Bank of Japan, the Swiss National Bank. You can sort of throw in Great Britain in there because her interest rates, I believe the Bank of England interest rates are 0.75%. So you can see that I've said that I believe that going long bonds is a good idea because it seems that interest rates will be declining. A lot of people are seeing this more as like a risk-on trade. So generally when you get out of equities and you put your money into bonds, but I think there are some people who are front running an eventual decline in interest rates. So going long bonds again, I would go long Australian bonds and Canadian bonds, and well, even American bonds, because I think they will be cutting rates. So the bond market is giving us signs that there will be some sort of rate cut as investors expect rates to drop. So let's look at the US Treasury yield curve here. So I want to focus your attention on the 1 month and the 3 month. We have a 30-year. So if you can see here, you can see that right now the 3 month at 2.22% is dominating the entire yield curve, except the 30-year. And just a couple of days ago, the 1 month was actually yielding higher than everything besides the 30-year. So again, the way you can look at this also is generally you expect a yield curve to be sloping upwards, a normal yield curve, because you expect the future to be better. So the longer you put your money away, the more it should yield because the future will be better. This is sort of telling us that people are uncertain and nervous about the future. They'd rather be putting money in the short term rather than investing in the long term. And generally, this is also a sign, yield curve, inverted yield curve, that some sort of potential fall is going to happen. Recession will be happening. So it is an ominous sign. Watch this. And if you follow my work, you know I'm always saying that we watch the bond market, because the bond market gives us all the clues. It's the largest market in the world. It is the debt market. So if you're the Federal Reserve right now, you want these rates, you want to sort of focus on cutting short-term rates, because that will make the short end of the curve go downwards, thereby maintaining a bit of a yield curve for the rest of the rates. So expect them to go lower just by looking at the yield curve. They pretty much have to act. I want to also talk about how they act, and that is the federal funds rate. So in the United States, the federal funds rate is the interest rate at which depository institutions lend reserve balances to other depository institutions overnight. So this is basically all these banks, they have to own part of their reserve in the central bank. It's funny, I'm just looking here at the story. A lot of people are talking about, the Fed will likely do nothing. And I'll get to that, but let's just quickly focus on this. So if you type in Fed funds, and it's not really a chart, but it's data, and it tells you what the effective federal funds rate is. Right now it is at 2.39%. 2.39%. So you have to realize a lot of these banks also put money in 10-year reserves. So let's look at the 10-year. 2.12%. 2.39 versus 2.12. That's what you call negative carry. So just by looking at this information, I'm expecting the Federal Reserve to be cutting rates sooner rather than later. Let's quickly look at these articles here that were here. Don't be sure the Fed is cutting rates. So let's tackle the inflation one first. So using the mandate that a central bank maximizes employment and handles inflation, just looking at the signs, so we had inflation data today. We'll go take a look at that, and it came in at quite a low number. Let's look at, so it came lower than expected, 0.1%. That's X food and energy, month over month. Even the year over year, 2.0%, so lower than expected. So just looking at this data, here is telling you, there's two ways. There's a way you can look at it. The Fed is not meeting its inflation targets. If the Fed is not meeting its inflation targets, that would be a sign for them to cut interest rates in order to stimulate some sort of inflation. Again, the only reason that this inflation isn't coming is something called the money velocity. So this is the money velocity chart that you can get on the Federal Reserve's website as well. Let's just look for one that is much more recent here. I mean, I can just go to their site, but since we're here, 2015. But essentially, what I want to prove is that the here we go, up to 2017. So the money velocity has not grown. You can see this is when we just started doing QE, started to print more money, and velocity has not grown. Money velocity has to increase in order for the economy to actually do well, because it shows you the speed that money is traveling through the economy. So this is their issue with inflation. There is no inflation because the money velocity is there is some inflation, but it's I personally think they might be underestimating some of the information or presenting false data, but that's neither here nor there. But they can't get that number because money velocity has not increased at all. So it's funny because I look at these articles about don't be sure the Fed is cutting or inflation here. It looks like the inflation data that's coming softly is sort of leaning towards an excuse for the Fed to actually cut rates. They can maintain the whole idea of everything was going well, the economy's strong, but we had to cut a bit because of inflation. But again, as we know, we can look at the Fed funds rate. We can look at the treasuries here, and this tells us alone that the Federal Reserve has to act. They have to cut rates. Let's look at this. So the whole idea of don't be so sure that the Fed is cutting rates. This is my opinion on that. So let's look at the stock markets here on the daily chart. I believe that this stock market, because again, if you believe the whole theory that the Federal Reserve and central banks in general have a mandate now to keep assets propped, this central bank here has the mandate, of keeping assets propped. And we're looking here at the stock market, the S&P here. I believe that the market started to move up because they are pricing in rate cuts. If rates go lower, that means bond yields go lower. Where else are you going to put your money? Are you going to put your money in bond yields yielding very, less than 2%? Or are you going to put your money into the stock market, which can bring you much more than 2% in a year, or sometimes even a month? So they're going to be forcing money into the stock market. And looking at this article here, I believe that the Fed, people are pricing in this rate cut. And if the Federal Reserve disappoints and does not cut rates, we can see a big fall in the equity markets. So this is where the Fed are in. They're in between a rock and hard place. I think they will have to cut rates. So again, the meeting is next week. Let's see what they'll do. It's funny because this year we started with, the Fed is going to raise interest rates 3 or 4 times. And now we're at a point where some analysts are even saying the Fed's going to cut 3 or 4 times this year. 3 times this year, 1 maybe next year. So will we start off this month? Again, I'm not saying they're going to cut next month. I know they're going to cut, this month. But I'm just saying that looking at the Fed funds and the Treasury data here, they have to act sooner rather than later. And I think the market is already pricing in this interest rate cut. So again, let's keep an eye on this. This is crazy times right now. If you follow my work on my blog and my social media, I've been talking about this since January of this year. I said that around March time, we'll start to see more dovishness in banks. And I said that they start cutting around summertime. So the Fed may cut next week. They might be very dovish next week and promise a rate cut in the summer. We'll just see and find out. Again, I believe the markets will be going higher because it wants rate cuts. And they're pricing in rate cuts. There's just nowhere else to go for yield right now except the stock market. Some people might argue real estate, but I argue the stock market. I think, if we see Canada and Australia start cutting real estate, generally when you start cutting interest rates, it doesn't stop with one, right? It keeps going and going. Like there's generally rate cuts and rate hikes come in a pattern of a couple in a row. So people who are into buying property, they might just say, okay, we had one rate cut. Why buy now when we know more cuts are coming? And that could create some sort of stagflation type event. So again, this is why I think more money will be going into the stock market, just because, of course, the markets are much more liquid than real estate, which can take some time to sell. So again, I hope you enjoyed this this content here on potential rate cuts. Again, keep an eye out on bonds. BND is the chart I use. And then I also look at the 10-year and the 30-year and also the 2-year. And I always look at the Treasury here. So this is telling you something. Media tries to make you focus on stocks, but they don't want to talk about the biggest market in the world, and that is the debt market. All right, guys. So thanks again for watching my video, and I'll talk to you guys later.